Hey, what's going on, y'all? So I got a couple questions via email around market profile and auction market theory. Uh, I s Luckily, I had a old presentation that I'd done for a small group here locally here in Texas on it. I think it was last quarter. And so I figured I'd just do a quick screen share and walk you through the presentation. So let's jump right into it. All right, so here's the presentation, market profile and auction market theory, understanding value, price, and time. And here we've got a market profile. You can see we've got a value area here highlighted where 70% of time was spent for that trading day. Um, each one of these profiles represents a single trading session. So I focus on the ES RT8 session, so the cash session, New York session, whatever you want to call it. Each letter here represents a 30-minute span of time. And the end of the session, you've got a distribution of time spent at various price intervals. Here in the center, I have an expanded profile. Kind of looks like a 30-minute candle chart with one letter representing a different period throughout the trading day and where price closed. So this is an expanded version of a profile. Uh, and here's what a collapse profile looks like. Just looks like generally some type of distribution. But yeah, the theory around market profile and why does price move the way it does. So let's do some quick background here. We're not going to have a history class, but origin of market profile was created by Peter Stedlemeyer. He was a statistician turned futures trader on the CME floor. He developed a market profile as a way of organizing the auction process and making sense of the chaotic noise of the day-to-day auction. He worked closely with Jim Dalton, who was became one of his students, I believe, and kind of evolved the concepts of market profile further after Stedlemeyer's death. Jim Dalton, most of you either know of him or have probably already read a couple of his books. Mind Over Markets is his big one. Markets and Profile is another popular one that came out in the 90s. And then I think last year he came out with his last book called Markets for Momentum, which is pretty good read. Dalton trades a little bit differently. I believe he's an options trader primarily, and he doesn't call himself a futures trader or a market profile trader, but he uses market profile to identify areas of interest. So here is a screenshot from Motive Wave. This is the ES December 2025 contract from last quarter. This is one way of how some people organize their setups. You've got here on the left-hand side, you've got these Tetris-looking bricks. That is your TPO chart or your market profile. And then here on the right, you've got what's called a volume profile. The gray area here on your market profile represents your value area or time, or where 70% of time was spent. And then on the volume profile, the gray area is the where 70% of the volume happened. You can use both, or you can pick one or the other. A lot of people gravitate towards using volume profile. I learned on market profile, it's just what I use. There are trade-offs for both, and both won't work every day. Some days the value area low of the market profile will be a major area of interest for buyers or sellers, whereas the value area low on the volume profile may be um, the more critical area inflection point. And I don't index too much on it. They're pretty much the same. Most days you'll see the value areas are 1 to 1. On different days, you may see some skew, and then on some extremely volatile days, you may see even more dramatic skew. Those are the exception, not the rule. More or less, you're going to get relatively the same levels, depending on if you're using market profile or volume profile. But this is just a chart just to illustrate what a standard profile looks like overlaid with interday candles overlaid on top. I think this is like 3 minute candles or something like that. But yeah, that's as far into the history we're going to get. But yeah, let's talk about auction market theory. So what's the purpose of any market? Well, the primary purpose of any market is to facilitate trade. It does this by auctioning price up and down to find a level where both buyers and sellers agree to do business. So if you go back here, price is oscillating. It is developing, or it is spending time in this range here and developing value. uh, Price reaches the upper bound of value and quickly moves back down to the lower bound of value, where it bounces up higher and kind of oscillates one more time. That's what we're doing. Um, the value area is where the most trade in that session was facilitated. Think of it as that way, where buyers and sellers agreed that price was most fair. Now, to the right, we've got this concept of balance versus imbalance. Balance is where buyers and sellers agree on value that we just talked about. That price kind of rotates within that range. We, as traders, we kind of identify that as chop. And we generally, I think most of us try and stay out of chop. We want to catch the imbalanced moves. One side where one side is being more aggressive and price tends to trend vertically to find new value. So going back to our example here, you could say that this most of this session here was balanced and within value. Once we probed that upper edge of value, sellers got aggressive and pushed price to the lower bound of value, where buyers stepped in and weren't able to really explore creating value at a higher bound. And the auction failed lower. Buyers took one more step in and sellers overwhelmed them. And in the next day, we explored value at lower prices. That is an example. This move here, imbalance down, still within value, but it's an imbalanced move lower. Think of it as an aggressive downward rotation to the lower end of value. This move here, that is an imbalanced move lower. This move here, this is an aggressive imbalance move lower. This entire section here is rotational, where value is being established at lower prices. That's a critical component to keep in mind once imbalance is stabilized. We'll talk more about that later. But so continuing on some of that, auction market theory, it's a framework for understanding market behavior. It's not a silver bullet. Think of the market as a continuous two-way auction where you have a buyer and a seller on one tick price at a price one tick above the current price and one tick below the current price. And then you've got passive buyers and sellers up and down the price ladder or the depth of market. If that's something you use, that's something you pay attention to. But the depth of market is probably the most raw visualization of the auction process, two-way auction process. This is a quote, I think, from Dalton, but a two-way auction, also known as a double auction, is a market where multiple buyers submit bids to purchase a good and multiple sellers submit asks to sell it simultaneously. And an intermediary or market institution then matches compatible bids and asks to clear the market, determining a final price where buyers and sellers can complete a transaction. Think of a real-world example so you don't have to think in an abstraction like a DOM is think of like local car sales or local real estate. As price gets ratcheted higher and euphoria starts setting in, you've got a new Toyota Tundra or a really popular house in a really popular neighborhood. Interest rate, mortgage rates are really low, lots of buyers. So sellers want to get the highest price possible. And so they're going to try and move inventory much more aggressively at higher prices. If you're sitting on a lot of 500 Toyota Tundras and you're selling them aggressively every weekend, every week, you're struggling to replenish your inventory, prices aren't high enough. So you're gonna offer fewer incentives, fewer discounts, and fewer incentives to get buyers in the door because buyers are being aggressive. Once those buyers start disappearing, though, that's when you start seeing the floor begin to lower. That's when you start seeing incentives where maybe a lower interest rate, maybe more upgrade packages. And then all of a sudden the price starts falling. Dealers start chopping down prices until they can find an equilibrium where buyers match their inventory and they're no longer sitting on uh, while they were being able to move 500 cars on a lot and not be able to keep inventory, they want to avoid the situation where they're sitting on 500 cars and they can't move them every week. So think of it as that example. I think Merritt Black from Apteros is the one who popularized that analogy. But auction market theory explains how price discovery in financial markets occurs through the ongoing interaction of buyers and sellers, creating a fair market price where supply meets demand. The market forms areas of value as participants agree on price levels. These are those clusters of trading activity or rotational areas or balance or equilibrium, whatever you want to call it. And then when price moves away from those value areas, it signals market imbalance. And there's rotational imbalance, which is more of like a slow grind higher or a slow grind lower. And then there's impulsive imbalance, which is more like thinking of a chart, a trading chart. Those are your trend days where price just barely makes a lower low or barely makes a new low before making a higher high. And that's what prompts buyers and sellers to step in and drive prices aggressively towards a new balance where buyers and sellers can agree on price and um, price will rotate and establish value there. So market profile and volume profile limitations. I mentioned that this isn't a silver bullet. A lot of people see a market profile chart and they think, "Oh, geez, what is this?" It's not a strategy, or I would even say an edge by itself. It's just a way to organize and visualize the two-way auction process of previous days. That second bullet is what it says that. And it helps you understand what's happened in the auction process in the past to better anticipate what can happen in the future as the auction develops. Uh, the edge really comes from the execution framework. All market profile or volume profile gives you is kind of a map for your intraday decision making. So that you can make your entries in areas where you're not being a sucker. Executions is unfortunately where most new traders fail, I think, outside of risk management. So this is Mind Over Markets by Jim Dalton. Price is simply an advertising mechanism. It signals opportunity, but doesn't dictate whether that opportunity is valid. Time regulates those opportunities, and volume ultimately measures the success or failure of all advertised opportunities. Let's go back to our screenshot from Motive Wave here. That time regulates opportunity piece from that Dalton quote is really important. So you see how we probed the upper edge of value here on this day. We didn't spend these are 3 minute candles, I think. We only spent like roughly 15 minutes above the value area high for that day's developing value area high. And price was quickly rejected lower. See this? Couldn't make a higher high swing low on that entire movement. Buyers Buyers stepped in here once we got to an extreme value area. We got below the previous day's value area. That's what this line is. Uh, Buyers stepped in briefly, but they couldn't sustain prices at higher prices, and they lost traction and eventually lost the auction, lost control of the auction. That's what that um, time regulates opportunities piece means, and volume ultimately measures the success or failure of all advertised opportunities. So I think back in the days that TPOs were developed by Stedlemeyer, they weren't able to get volume data end of day, so they used time as a proxy for volume. Now, everyone has access to volume. So I think a lot of people, I think that's part of why folks gravitate towards volume profile, but think of it as time regulating it. So time or volume building at higher or lower prices signals acceptance. So we kind of touched on this at the beginning when I was walking you through what was at the start of my presentation, but market profile, it's not a technical indicator, it's a data organization tool, and it just structures the auction process. Like again, um, plots time price opportunity to displace distribution of trading activity over time at specific price levels, creating a bell-shaped curve on balance days. So A period is the open. So we opened up here, price oscillated a little bit higher and before ratcheting lower. B period came in. All right, explored lower and was rejected. And sorry, that was my dog. I think we got some food delivered. And you could see the rotational behavior of this auction. One second. Let me go ahead. Never mind. But yeah, that's kind of a TPO. So what constants, what are the pieces of a TPO chart? So we've got the initial balance, which is the range established during the first hour of trading. It sets the tone for today's probable range and settlement. Um, I'm not big on trading the initial balance. I keep it, or it's marked here on these charts here in this yellow bar. This shows you the range of that initial balance area. A lot of people trade off of that. I generally ignore it for the most part. Um, it kind of like I think a large range initial balance range is seen as like a potential for trend days. A very narrow initial balance range. Some people interpret that as potential rotational or choppy day, things of that nature. Point of control is the price level with the most TPOs or time spent or the highest volume on a volume profile chart, and it represents the fairest price for the day. I will generally avoid taking trades at a prior day's point of control just because that's where you're going to see a lot of rotational behavior. That's where the most transactions and time was spent in the prior day. And unless it's a naked point of control that has been untested, I'm not really looking at that. I'm cognizant of the level. I'm watching to see if the order flow changes there, but it's not really an area I'm too keen to get involved in. Next up, we have the value area. We've been talking about this, but it's the range of prices where 70% of the day's trading volume or TPOs occurred. This is where value was established. So you've got a value area high and a value area low. I generally try to avoid initiating trades in the in between areas. I really want to see moves outside of value, and I watch order flow for signs for continuation of that move or rejection of that move. So visualizing value, I kind of just scratch pad together on what this looks like on a chart and how like a traditional price action trader might uh, draw this. Here you've got your range, and then you've got an impulsive imbalance move lower. Price advertises opportunity, time regulates that opportunity. So how much time you've spent at lower prices indicates acceptance, and then volume measures the success of that auction. The bell curve visualizes this relationship. A fat curve indicates acceptance or value, while a thin profile indicates rejection, unfair prices. Let me see. Yeah. So let's say let's say we spent a lot of time up here and we put like a P-shaped distribution up here, that would signal acceptance in that case. Key reference levels. This is how I use market profile to prep for my day. Just because we hit one of these points doesn't mean I'm going to take a trade. Like if we hit yesterday's value area low, that doesn't mean I'm shopping for longs. If we hit yesterday's value area high, that also doesn't mean I'm shopping for shorts. I'm just looking to see if we see any initiative behavior from one side of the auction at those levels. So a value area high is the upper layer of value. Think of it as resistance in a balanced market. So if you're seeing a range day or a rotational day, think of it as resistance, but also think of it as support with a bullish breakout. If you're going to see continuation of higher prices, you don't want to see that value area fail. Point of control, a lot of times, yes, it does act like a magnet, but that magnet creates a lot of chop in my experience. Price definitely returns there. And I think the first return is usually pretty important. So on day two, if we sell off lower back inside of the previous day's value area, and we touch that yesterday's point of control for the first time, I'm going to be more inclined to take a trade there if order flow shows me that one side of the auction is getting involved heavily at that area. Otherwise, I'm just going to assume that we're going to continue rotating. Value area low, so that's the lower bound of value. Think of it as support in a range bound or balance market, and think of it as resistance if you see a bearish breakout. So let's say price loses that value area low and then comes back briefly for a retest. That would be a signal to you for a potential short opportunity there. Cool. So this is kind of illustrated here on a profile. So this is, you saw some upward momentum and value established at higher prices here on this day. And then we opened outside of value, but we got sucked back into the prior day's value area before closing the auction up here at that red triangle outside of not just yesterday's prior value, but also out of today's auctions value. So prices accepted outside of or at higher prices. And then here I have the point of control highlighted with in red text with a red line. Responsive versus initiative behavior. We've touched on this a little bit, but responsive trading occurs when price opens outside of value and returns towards it. So think of it as buy low, sell high. This is kind of a good example of this. So we, at the tail end of this day's trading, we establish value up here and acceptance. And then in the next day's session, we opened higher with an initial drive in the open, which was rejected back into value. And the B period, that's the second 30-minute period of the trading day, went all the way down here, closed out these purple single prints from the prior day before working its way up higher into the close. Initiative trading occurs when price breaks away from value and gains acceptance. So think of it as buy high, sell higher during a trend or imbalance. So when price spikes out the gate at the 9:30 Eastern bell, 8:30 Central Time, price doesn't come back to that initial balance high. It just keeps making higher highs relentlessly. I think this is something only of like 12% of days, but you do see initiative behavior within a trading day. It doesn't mean the entire session is going to be continuously printing higher highs every 15-minute candle. You can look for initiative trading in pockets throughout the day. And I use order flow to kind of understand when that's happening. All right, I put together some further reading and resources that have helped me over the years. Stedlemeyer on markets, Markets and Market Logic are books by Peter Stedlemeyer. He's the godfather of market profile. All great books. Same with Jim Dalton, Mind Over Markets, Markets and Profile, and Markets and Momentum. These are all classics. Highly recommend them. And then a little bit harder to find is this third one here, Value-Based Power Trading by Don Jones. This is getting a little bit more into some nuance of how market profile has evolved. I think this came out in 1992, I believe. Apteros Trading, the Nadro course by Merritt Black is phenomenal. This is what I would consider the most, I guess, useful application of market profile. Jim Dalton, Stedlemeyer's books are more about structuring the auction process and understanding it day over day. There's not too much on execution there. Execution still is kind of a big question mark. At least it was for me when I read Dalton and Stedlemeyer. Apteros, and even Don Jones' book, Value-Based Power Trading, kind of gave me a little bit more meat on the bones. Definitely with the Nadra course from Apteros. That's really what made it click for me. And then Flowhorse on YouTube, he does a really great overview of order flow trading in general, from market profile, volume profile, footprint charts, DOM trading, all that good stuff. He's got a really popular playlist on market profile that all of you should check out if you haven't already. But yeah, that's the presentation. Hope everyone enjoyed it, and we'll see you next time. All right. Good luck next week.